Good morning, ladies and gentlemen. Well, over the course of the past week, the risk dial has actually improved slightly. Not very much, as you can see. It was stuck at 57. It ignored all the small gyrations in the market and then jumped 2 points to 59. It basically, the daily model gave us a buy on Thursday of the week before last when it went positive. That was on the 18th. So we are invested in equities on the daily model, while the weekly model is still improving on to the rate of about 8 points per week, and it will give us a buy model unless things change dramatically sometime in uh, in 2 weeks' time. It will then give us a further 60% allocation to equities, while the monthly model will probably take another 2 months or so to give us a complete allocation into equities for that one as well, which is 20 basis points. All the figures of the daily moving averages are in these boxes below the charts, and you can see here in the scoreboard what the price of the investment is and the date of that investment. So as far as the risk model is concerned, things keep on improving. The spreads keep on improving. Remember, this is a model based on spreads and not on the price of individual individual sectors or even in the price of equities overall. So this is saying the market is healthy, the breadth is good, the internals are good and improving. Why the market is being so sluggish, you can see in the deviations tab. We are very hard against the red zone in the SPY, and that is why the market cannot really manage a sustained move higher of any degree. As you can see, every time in the past it has tried to get into the red zone, it has always backed off, and that is basically what we're doing at the moment. The individual sectors even better tell you why we cannot improve that much. XLE, as you can see, is very much stuck between the red and the green zone. Here we have the telecoms, IYZ, that has a little bit of room on the upside, but not that much. XLU is coming up against very tough resistance at the previous highs. And you have XLB, which has backed off from the unsustainable level that it was at. And here we have XLK, which is at the moment still the driver, telling you that the improvements in XLK are going to be marginal at best on the upside. And therefore, since XLK is the only large sector, together with XLF, which is now in the red, that is telling you why SPY cannot really improve that much. I would expect XLF now to start trading sideways for at least a couple of weeks before going up again. And here we have XLV, which to me is actually the sector which the only sector that can improve, but it has no reason to improve. XLV will now be a very tough sector to trade for a whole year because the healthcare plan and the politics, the presidential politics, are interfering with it. It's going to be a very, very tough sector going up and down, and that is actually going to be the reason, since it's the second largest sector after XLK, why the market cannot improve that much. It can improve slightly, but overall not that much. One last thing I wanted to show you is that even the allocation model in this tab has now switched to SPY. It is saying SPY out of all these sectors is the one which has the highest odds of improving over the short to medium term. So it's preferring SPY to cash, it's preferring it to bonds, TLT, it's preferring it to gold, and it's preferring it to equity, commodities. So that is just another sign that we are in a buy the dip kind of market. As you know, I believe that bond yields drive absolutely all valuations in all asset classes. And here we have the bunds, which are to me one of the most important bond markets at the moment. It's been proved that 8 basis points is the swing level. The market never managed to close through 8 basis points positive, and a market which can't close even above 8 basis points positive then collapses. 2 basis points, minus 2 basis points, I'm sorry, is a very important level which we have now achieved. And the next level is down here at around the minus 9 basis points, followed by a very important level at minus 12 basis points. What is that telling us? That is telling us that there is absolutely no inflation pressure and there is absolutely no pressure on rates coming out of the EU. If the EU continues with negative rates, that that quantitative easing that the EU is doing produces free euros. These free euros are then swapped for dollars, and then finally they're invested in the stock market or in the bond market or anything with any kind of yield. That is at the moment the driver of everything. Every time the markets dip in the States, there is a wave of buying from the liquidity being generated by the ECB. And as you can see, because of the tremendous bond weakness in the yields, we are still stuck in this corridor where I believe the central banks are managing liquidity and also volatility as a result. We're still stuck in a 14 basis points differential between bunds and 10-year notes, minus 245, minus 258. And if we were to start breaking this on the downside, that will signify a major acceleration in the dollar. Even the fact that we are stuck here is dollar supportive. But if we were to actually start going below minus 258, you will start seeing major spikes in the DXY as people just flood out of Europe and other investments and seeks the safety of the yields, of the higher yields in the state. Here we have the 5-year note yield. If I enlarge this, you will see that the market, every time it jumps slightly, it gets smacked back down because there is just too much liquidity around. We do have our very important levels at 236, but I don't think the market is going to manage to close above 236 for too long. We have this 50-day moving average capping it. Anytime it gets to 236 or slightly higher, it's probably a very good sell in terms of yield, and you buy futures. Eventually this will slowly head and fill these gaps which it left around the 222 level. I would expect over the course of the next 2 or 3 weeks the 5-year note to definitely trade at 222, if not just below 220. Much the same is visible in the 10-year note. The 5s to 10s are slightly steepening. People are preferring the short end, which makes sense. You should always now invest in the belly of the curve in treasuries, and that is the 5-year. I would have thought it's going to be very hard to see yields back up above 261. This level has been here for a long time, and every time the market approaches is then smacked down quite hard. At some stage, I certainly think that we will fill this level around the 239. but I don't see US yields being the main driver. I think they're going to be very much stuck together with Bund yields. So if Bund yields go to -12, we'll get the pressure to go back down to this level at 240, and conversely when Bund yields go back up. But there is absolutely no reason to expect Bund yields to go higher. In fact, there is every reason to expect Bund yields to trade at -12 basis points and then possibly eventually to make new all-time lows in yield. The liquidity pouring out of Europe is having an effect on DXY. As you know, I've been looking at this for a long time, and I've been telling you about these levels, 9650 being the important yearly swing level. And we have now been above 9650 for a long time, and we started breaking out above 9754 and 9787. These will now act as support. We are long calls. The market now just needs to digest this period of above the daily Bollinger Bands. As you can see, it probably needs definitely to come down to 97.54, but that's going to be another wonderful opportunity to buy calls. Even 97.87 is proving very tough to break on the downside. The retracements in the DXY are minimal. This is a very important candle, as is this one. We started breaking up, and I think the retracements are going to be very shallow, and eventually we do a handle and we go up. We go up probably quite hard. The next level after 97.87, which I would expect to be reached in a few weeks, is 99.79, followed by 101.92. Those are the levels that you should have in mind. It's trading beautifully in this kind of channel. Only a break of 96.50 is going to have any consequences for the dollar, but that is very hard to see because there is absolutely no macro reason for it to do that at the moment. The story about liquidity pouring into the US continues unabated. People are selling all other currencies, buying the dollar and buying US assets. If we switch the dollar view to a weekly view, we can see how significant this break is. We have here the MACD going higher. It has lots of room. The stochastics, although overbought, could do something like this, and therefore we have quite a bit of room on the upside. If we enlarge this, you will see the beautiful break up, and I expect the market now to slowly over the course of the next several weeks attack 99.79, which is the next important level. We have consolidated in this 93.63 to call it 97.54 area for or even lower, around 96.50 for something like 30 weeks, and therefore that has built up a lot of momentum, a lot of ammunition for a relatively quick, in weekly terms, move to 99.79 and then higher. What about equities? Well, they're doing absolutely nothing wrong. The SPX, you cannot fault it. Technically, it's trading perfectly. To me, while it's above this red line, which is ascending rapidly, is now 28.83, the market is just in a very good spot. Every time there's any kind of a dip, it's bought very quickly, and on Friday we closed at the highs, 1 point away from the all-time highs, which is absolutely nothing. However, the market, as I showed you, is tired in terms of how high the price can go, simply because it is so rich to everything, but every time it dips, it gets bought. To me, the upside is very limited in terms of how many points it can gain in a day or in a week for that matter. But what is much more important is that the uptrend is very much intact. And while it is, there is absolutely no reason to suppose that you should be doing any kind of bearish strategies. It's very much a buy the dip market until it tells you that it's no longer so. To me, this 28.63 support is still going to be the be-all and end-all. It's very unlikely, I think, that the market breaks it over the course of the next few weeks. It is going to be a question of buying it against this 28.25 level, and if that were to give way, then we are looking at these moving averages coming into play on a daily basis. And don't forget that will be higher. So we're talking about the 28.90 to 29.10 area. We are playing here for micro points. We're playing for 1%, 2% maximum. And in fact, on an intraday basis, we are playing for something like five ticks. You just have to change your expectations when you are in this kind of a market. The upside will not give you huge rips, and the downside will not give you huge dips to buy. From a fundamental point, we're now hard up against the times 17 Blue Angel of forward earnings. That has always been a very, very good level of resistance for higher prices. We could be in a period like here in early 2015 when we just sort of trudged along, hitting the times 17 and trading 1 to 2 percentage points below it. That is certainly a possibility. The other possibility is just a melt up as liquidity comes in and takes us to the 18 times Blue Angel. That is the lower probability event. But that is why I keep on saying to you, switch out of your longs into calls. Volatility is so cheap that it certainly should pay to do so. You have to be invested in the market, but if you're going to be invested, be smart. At these levels, the danger of a fall of more than 2-3% is actually quite elevated, simply because nobody's expecting it, and therefore giving up 1.25% in volatility terms for long-term calls is really quite a bargain. And this is a weekly chart of ES, and why I say that there is a possibility of a melt-up. Simply because the Bollinger Bands, and always throughout its history, ES has traded up to its top Bollinger Band when in an uptrend. They don't really come in till 3020. So there is definitely a possibility of a sharp spike higher to above 3000 in the SPX. I don't expect it. I think the market is going to be more sensible and is going to trade around the time 17 Blue Angel, as I showed you, but I cannot exclude the possibility of a melt-up. And that is why calls and call spreads are a much more favored way to trade this market rather than outright positioning. The other reason why I think a melt-up is actually less likely than the base case, which is trading in a 2% range with 29.40-ish being somewhere around the top, is because the only sector which can really help the overall averages is XLK and therefore NQ. If we have a look at what NQ has done, it has been up for 1, 2, 3, 4, 5, 6, 7, 8 weeks on the trot. We have taken it to unsustainable levels here on the technicals, on the stochastics. Can we go higher? Absolutely. But we are so close to the top of the Bollinger Bands. The whole of XLK cannot really give it much more than 1 to 2% on the upside, and if it's 20% of the index, that really only gives it less than 0.5% to the whole of SPY, something that can be quickly negated by either the financials or even the XLV, which is the pharmaceuticals and the defensives. So it is unlikely that even if we were to go to the top of the Bollinger Band here around the 8,000 level next week, that the market can really go up that much in terms of SPY, simply because all the other sectors are going to be holding it back. The final reason why I don't think we are in for a melt up, although I cannot exclude it, is that the transports and the industrials are not making new highs. We would need at least the industrials to make a new high above 27,000, which has to be followed as a confirmation to above 11,500 in the transports. I don't see that happening, simply because the pattern is one of sideways continuation rather than immediate blow off. I think it might take several more weeks, and May is traditionally a bearish month for the market, so the seasonals aren't all that great. But I absolutely think that a pause at these levels in SPX is actually excellent longer term. I think if we go and bust 3,000 now, that is unsustainable. I'd much prefer to see 1 or 2 months of backing and filling down to 28.68, trading 29.50, 60 down to 20, and coming off 100 points and then staying in a sideways range. So 29.60, 28.60, and then we will be ready for a strong move higher in the middle of summer or in autumn late. This is a weekly chart of DAX, and if I enlarge it, we can see that we are now actually at the 0.618 retracement of the whole move down. Now DAX should be the weakest market. It has broken through the trendline resistance, which I didn't give much credence to, but here we are at 0.618 of the whole move down at 12,340. It should take some time to break through there. It's been up 1, 2, 3, 4, 5 weeks on the trot. It's come up 1,000 points. It should slowly trade this level before breaking higher. But if it starts breaking through 12,340, 50 last week's highs, then we don't really have very much until 12,600. There is no reason to think that we're going to go and collapse below 12,000, but there is every reason to think that we should actually be trading sideways now, using this kind of trend line as a support on the way down, and then forming some sort of a cup and handle pattern and breaking up towards the end of the summer. What is volatility telling us? Well, volatility has been truly neutered. If you look at the way the Bollinger Bands are collapsing in, that is telling me that we're going to trade 1110 up to a maximum in volatility of 1480. That, given the steepness of the curve, will make it almost impossible for VXXB to have sustained rallies. And that also tells me that we are stuck in a range here in the SPX. I would have thought that if we are going to have a melt up, volatility should actually rise. And that I don't see happening. On a melt up of 100, 200 points, volatility should definitely rise, because volatility is looking for movement. It's not looking for movement up, it's looking for movement anywhere. And therefore, I remember very clearly in the 90s when volatility used to go berserk, when the market was going up 1, 2, 3%. And I don't expect that to happen. I expect volatility now to be very much contained in a range, and that will actually tells me that we are stuck very close to these levels for the foreseeable future. Finally, I wanted to have a word about one of the contracts which actually has the most potential if we are in some kind of an equity uptrend. I say if because I'm not convinced, but here we are. We have TF, which has been the Russell, which has been lagging so badly. Is you can see it's still below the highs that he made in March, and while the SPX has gone up by leaps and bounds since then, we are still below that level in the Russell 2000. We are not going to get any kind of impulsion in Russell until we break 1602.1 on the RUT, that's the actual index, on a weekly basis. If we do that, then we will probably go to the top of the Bollinger Band. This is definitely the one to watch to give you, because if this index now starts going, you can forget about dips in the SPX, unlikely to happen. Certainly the dips are going to be very much contained and they will be bought ferociously. So is there a possibility that we go up to 1670 in the in the RUT? Absolutely. We could have a rotation up into the Russell, and that is what I'm going to be watching particularly hard next week. And here we now have the biases for next week. Basically, I've changed the format. I've deleted everything just because it was getting too messy. Now the 5 years, as I said, are trapped in this 225 to 240 range, and the 10-year in 240 260, basically following the Bunds and staying in that channel I showed you. The Bund is to me the important one. 0.0088 basis points is the real swing level. While it stays below there, it is going lower in yield. We are looking at 0.9 basis points and then minus 0.125 basis points. To me, that is, I prefer to play in the Bunds because it makes sense to me. I do have a natural stop and I have a target, and therefore I know my risk absolutely. The SPX, as I've told you, I think it's unlikely to have very strong spurts upwards simply because the technicals no longer support it. We are at the time 17 Blue Angels, and we are so close to the red zone in the deviations that really it would be unsustainable if we got a strong move up. Plus, as I showed you, very few sectors are in a position to help, and therefore the only one that can is NQ, and I'll be watching that one for the melt up. 77.50 in NQ to me is the big tell. Should you ever trade down there, it's a level to fill your boots in terms of options, because if we go down through there, then it's going to be all hell's going to break loose. But until broken, it will be what will ultimately prove an unsustainable grind. RU2 is the one that I'll be watching next week strongly, because that is the one that if it breaks 1602, 1603, it'll confirm a rotation into Russell, probably out of SPX and NQ. The VIX, as I told you, is now stuck in an 1150 to 1425 range. That, coupled with the steepness of the curve, makes VXXB a natural sell on spikes, and I will definitely be tweeting you all the levels that I'm selling VXXB next week. It's an opportunistic trade. You're looking to make 50, 70, 100 points in VXXB, which is always nice to have. I've told you what I think about the DAX. We are at 0.618. If we don't stay around here, we're going to 12,650, probably quite quickly, and that is going to be another reason why all these markets are strongly supported. To me, the big trade still is DXY. any pullback, especially down to 97.54, you should be adding to your positions. It is a really good risk reward trade. I am definitely adding to my positions on any pullback, because we know where we're wrong. And 96.50, a weekly close below 96.50, and something very bad is happening. And therefore, this being only 100 points, we know exactly what our risk is and where we should be trading. There is no reason for the dollar to be lower. There's every reason for the dollar now to go higher, and these are the immediate targets: 99.75 and eventually 101.92. Thank you very much indeed, and tweet you on Monday.